Lex, it's always great to have you on the show.
My pleasure. Thanks for getting this together.
Yeah, well, it's always fun to talk to you. In fact, I was just realizing this morning that you are my most frequent guest between this podcast and between now and success. You've been the one that I've interviewed the most. So I know that means that you're one of the wisest folks that I know out there. So I always appreciate when I get a chance to chat with you.
It's very, very kind of you. I think I just change change focus and identity enough to make it interesting every
Yeah.
time.
Yeah. For those of you watching the video here, speaking of identity, you've got a really nice Van Gogh as your background there. So very cool.
2020 behind us. It's time for spring.
It is, absolutely. All right. Well, let's dig into this. I thought where we could start today is talking about Robinhood, because as we're having our conversation here, Robinhood and Wall Street Bets is definitely in the news. But I don't really want to talk so much about Wall Street Bets as I do about Robinhood, because I think that is a nice lens into the whole conversation here. And I'd like to talk about, how does Robinhood make money? And really discussing a little bit about the value chain of financial services, fintech, wealth tech, where that's heading. And that I think is going to get us into DeFi a little bit. So let's just start with Robinhood. I know you're very familiar with them. How do they actually make money?
What a beautiful question.
Or do they make money?
No. They definitely Robinhood definitely makes money. I think in 2020, my guess is they made somewhere between 600 million and a little bit over a billion in money. So, as far as fintechs that deserve an IPO go, they certainly are one of them. The kind of not unusual thing, but to somebody who's been in financial advice and in wealth management and has really been brought up around asset allocation and giving clients financial planning advice, this is a completely different animal, and it's one that's not really about getting people to some particular destination, and it's much more I think an arbitrage on the market structure of institutional capital markets. So you have to think not about, how much is a consumer willing to pay for a trade, which is a very 1990s way to think at this point. I'm not saying that's good or bad. It's probably very bad that's the change. But rather, what does it mean to own a stock? Where does the stock live? And then up that value chain, through the exchange, through the settlement house, through the exchange, to the broker dealer, to the mobile interface. I'm pretty sure I forgot the market maker there. So, the short answer to your question is that Robinhood aggregates consumer demand for buying stocks, and then it sends that demand to a market maker like a Citadel Securities, not to be confused with a hedge fund, or like Virtu Financial, or any other number of high frequency trading shops that don't care about the direction the market is going, but do care about providing trading and taking a spread on that trading. So it's not nefarious in any way. It's not, you don't have to take a cynical view of this, because market makers are useful and they're willing to pay 10% or whatever it is of their revenues to essentially do lead generation and acquire order flow. And so Robinhood makes 600 million, a billion in revenue for helping Citadel and others make 5 billion, 10 billion in revenue of spread for executing these trades. I think there's a whole can of worms around best execution and around, if you're very cynical, front running, and other sort of structural issues for trading. But the core insight for Robinhood is that you can make a large enough business if you aggregate all the consumer order flow.
And what's interesting is that the valuation that's placed on that. So there's been talk that Robinhood was going to go public. Maybe that's been shelved for a while because of this whole Wall Street Bets issue. But I think the valuation or the multiple that was going to be placed on Robinhood was dramatically higher than, say, a financial advisor, which is higher up on the food chain in terms of giving advice. And then they place a trade and it goes to Robinhood and it goes to Citadel or Virtu or whoever these others are. How do you think about that in terms of where the real value is in the whole chain of value that's provided in financial services? Is it just because Robinhood is growing so fast and that it's so scalable that they can get a high multiple relative to a financial advisor? Or how do you think about that?
It's a really hard question for me to answer without getting into very obvious trouble with some part of your audience. But I'll answer it rhetorically, and I think we also kind of have to slow down and disambiguate some of this stuff. I mean, on its face, an RIA is 100 times less valuable than a fintech. That's start and finish. There's just nothing else to say about it. It's not even, there's not like an insight there. An RIA is going to trade at whatever it is, 1.5 to 2.5 of your T12. And a Robinhood's going to trade 100x revenue. And that's the market, so whatever sets of emotions people have about this, I would recommend they just kind of put them to the side, because it's just what the current price is clear at. And you can point to bubbles, you can say whatever you like, but there are good reasons for this. There are good reasons why JP Morgan and Goldman Sachs would like to be called technology companies. And that's because finance companies are dead and technology companies are what's left. And again, I make these very rhetorical points, and you can think about another way to cut it is all the finance companies doing digital transformation and, investing in tech. If you were to bet who's going to be more valuable, a finance company doing digital transformation to be a tech company, or a tech company adding financial features? I think we all have this intuition about what is sort of more dangerous naturally, and so.
Well, and I think United Capital, I mean, they were a financial firm who tried to put a tech overlay on it and try and get a tech valuation. And I think maybe they were sort of in the middle because they had a really nice exit to Goldman Sachs and got a pretty nice multiple, but certainly not a Robinhood multiple.
Yeah. And look, I think what's really fair to say is there are many ways you can point out the irrationality, or you can point out the structure of the venture capital industry as creating these really high multiples, and the sort of hidden fund water flows in the legal agreements that kind of bring the multiples down, right? So for example, if you're the last money in, you're protected and you've got dilution all the way down for the earlier investors. And so the 100x might look one way, but if things go wrong, the risk profile of the earlier VCs is very steep and dangerous. And so there are all sorts of games behind the actual numbers. I think one way to kind of to find comfort around it is to think about risk profiles. So if you're building out a United Capital, or if you're building out a tech-enabled RIA, or if you're building out a Dynasty, or even if you're building out Marcus at Goldman, you have a somewhat linear path. You are controlling your downside. You generally know what you should be doing. You're trying to be more efficient. You're trying to serve more people. You're plugging in your CRMs and portfolio management together. And so you have a lower upside and then lower downside. With these other plays, it's really all tail risk. So it's either nothing at all or the whole market. And much of the Silicon Valley approach is to what's called blitz scale, to grab the whole market. And so Robinhood is playing to be a monopoly. It's not playing to be one out of 15,000 RIAs that are serving 300 very wealthy clients. It's trying to overthrow Schwab and TD and so on, and to do so by pricing at zero. So you take that, you take the growth, you take the whatever it is, 20 million users, the relationships with basically the disintermediating relationships with the market makers, that sidestep the custodians entirely, and that's how you get to the crazy prices.
Yeah, and so we've got Robinhood, which if they were not the first one to charge zero commissions on trades, they were certainly the one I think that popularized it. And then you had TD Ameritrade and you had Schwab that followed suit sometime after. So we've got this race to the bottom in terms of the transactions fees, which are now zero. But I think it goes even further than that because you're obviously heavily involved in the DeFi space. And that's where I really want to talk about next is, first of all, we're going to have to get a definition of DeFi. And, we're going to risk going down the rabbit hole on this because this can get kind of complicated. But I want to discuss where the financial industry is evolving and how people are going to interact with the financial industry, both from a investment standpoint in terms of how the way that we invest might change down the road, and then also from a personal finance standpoint. And I've got a question that I want to ask you about how this decentralized finance system might work from a personal finance situation. But I'm just going to give a quote here. You have a newsletter that you publish called FinTech Blueprint, which I subscribe to. There's a free version of it and there's a paid version. And you do such a great job. I want to support you. And I have your paid version too. But in it, you said, and I'm going to quote here, unlike FinTech, which went after distribution, blockchain goes after manufacturing. If you are a trader or market maker on Ethereum, there is no clearinghouse. There is no broker dealer. There is only you and the distributed machine with its smart contracts, automated rule sets, and software enforced property rights. All data is real time. The blocks click into being one after another without a single lawyerly piece of paper in sight. Hundreds of millions of people in the world have touched this asset class, and it renders financial intermediaries unnecessary in their imagination. So a bit of a long quote there, but hopefully that's kind of a good segue here into this idea of decentralized finance, or DeFi for short. So let's just start with kind of a brief definition of what DeFi is, and then we can talk about how that is changing the nature of financial services and where that may lead, and what we as financial professionals and also other people listening to this that just might be the general public who's interested in investing, what that may mean for them. All in 60 seconds.
Yeah. Good luck.
Yeah.
Brevity is not a strength of mine,
Yeah.
as you know at this point. So look, just a fair warning. I use rhetoric on purpose. I think it's important to recognize that on a road, you might have a horse and buggy, and then you might have a car with gasoline in it, and then you might also have a self-driving electric Tesla in the year 2021. All of those coexist. One is not worse than the other. There's just, for me, it's the edge that's interesting. And I think regardless of where you are in the industry, I think the edge should be interesting to you because it tells you the direction of travel, not just for the software you use, but for what your clients and their children are actually doing, right? Because we're all stuck in our house on TikTok or Facebook or LinkedIn, and I promise you people are crypto trading. So going back to definitions, decentralized finance is you can split it into two tracks. Track number one is the actual asset class. So the thing that you invest into, if you look at an asset allocation, in your alternatives bucket, there is a new 10% slice, which is crypto assets. So you have to learn about that and the exposures of that and think about it on its own terms. And then separate and apart from that is the financial infrastructure, the software machine on which these assets are made. Now, all asset classes have some underlying financial infrastructure. They're made by something, whether it is Fiserv or Envestnet or the NASDAQ technology suite or FIS or Visa or whatever it takes. And there are hundreds of billions of dollars worth of that, essentially financial middleware. to generate the asset class exposures that people put into their portfolios. Decentralized finance is the next generation version of that in a very real way. It is an entirely different set of infrastructure and rails. And there are a couple of trends and attributes that I think are really important to absorb about it. So the first is that computing, technology generally, but computing in particular, changes over time. And we went from very large warehouse kind of supercomputers with tickets, and then down to a personal computer and a desktop, down to a laptop and a phone, to the cloud, where most computing is happening on AWS and Microsoft's cloud and so on. And so the nature of where the math happens changes. And the next computing paradigm, and this is not me embellishing, this is just the sort of description of it, is a computing paradigm that is done on a network where lots of people or organizations hold or run what are called nodes, each running the software. And then the nodes are automatically synced using fairly complicated mathematics. And so instead of computing happening in one place, it's happening in a distributed way in thousands and thousands of places, and then it syncs automatically. You don't need 3 analysts every morning to figure out what the price of that option is on Fidelity versus Schwab. All of that goes away. So the software, the computing paradigm, is that software is synced across all the participants. And what that allows you to do is have a common data set. And then it allows you to have a common set of virtual assets that are accounted for and represented for on this network. There are different technologies to do it. The one that's kind of the core one is called Ethereum. ConsenSys is an Ethereum company, and so we're very close to this technology. On Ethereum, there are people are essentially writing software. The portfolio management version of decentralized finance, the lending underwriting version, the payments version. All of these bits of software are deployed in an open source way. As an aside, remember that the rocket Elon Musk sent to the International Space Station ran Linux, open source software, not Microsoft or Apple. So all of these financial softwares are written in an open source way and plugged into the network. And now have about 25 billion of value traveling through them. And so I think again, to bring it together, what people should keep in mind is that there's a set of these machines that make the asset class that are novel and interesting. And then there is the asset class itself, which lots of people have emotions about, but I think is separate and distinct from the innovation of the infrastructure.
Yeah, and I would spend the bulk of our time here on the actual asset class, the potential investments in a DeFi environment. But just one quick thing on the actual infrastructure of DeFi. Is it your thinking that at some point when DeFi continues to get built out and evolve, is that going to dramatically lower the cost of doing financial services because this stuff is all decentralized? There's not lawyers involved, like you mentioned, that all of this is happening through smart contracts. Is that going to continue to take cost out of the system?
I'm so self-radicalized here that it's hard for me to not answer very enthusiastically.
Well, I want you to answer what you believe. I mean, don't hold back for fear of upsetting someone that's listening to this.
I want people to find the thing they believe here, and so I don't want to shock anybody into compliance. But speaking of compliance, of course, the bridges into the system are going to be regulated, and those rule sets and precautions will extend into whatever financial sea that we travel in. So I do believe that they will interoperate with what we've got today. I don't believe that today's crypto ecosystem is quote unquote any worse than the actual financial system that we're in. I think people who tell that to themselves are really enjoying a fantasy to make themselves feel better. When Capital One has to pay a $390 million fine for enabling money laundering for 6 years in New Jersey, 390 million is, scale far beyond anything anyone is complaining in crypto about. But putting that aside, the answer is already today, large portions, I would say 80–85% of the financial value chain are rendered entirely useless and meaningless by DeFi technology. I legitimately mean already today. They are disconnected in many parts from traditional assets. And I think the question really is, how deeply integrated will they go into the manufacturing of traditional assets? It is very possible that in 80 years, only the novel assets will be the thing that people hold, or in 50 years, that the things you earn in the virtual world are more valuable, more existential, more interesting to the kids that are growing up on Roblox and things of that nature than a piece of debt from a company. So I don't know how much sort of one engulfs the other and in which direction, but certainly already today you can issue, so this is capital markets talk. You can issue an asset with different exposure. You can issue faux equity, or you can issue various liabilities. You can underwrite, so you can take out loans depending on various criteria, often collateralized, but increasingly uncollateralized. You can put into the collateralization box real world assets, commercial real estate, supply chain invoices, issue synthetic cash equivalents. You can tranche them, you can do insurance on them, whatever you like. And all of this is done in the same format. So the idea that a venture capital instrument or a hedge fund instrument or a fixed income instrument or an equities instrument has different market infrastructure just becomes deeply embarrassing, the same way that reconciliation is embarrassing, because it's just all software and it's in the same standard, the same way, to anchor it, the same way that on the internet, does it matter if it's a book, a video, or a newspaper? And the answer is, of course not. Similarly, in this system, there's no distinction between trading one type of exposure versus another, because it's just software.
So let's talk about the assets within a DeFi environment and also a personal finance example. So let's start with a personal finance example. So let's say that I have $500,000 of Bitcoin and I want to buy a house. And let's say the house costs, let's say it's $1 million house, and I have to put 20% down. So I need to come up with 200,000 of US dollars to put down as a 20% deposit on this $1 million house. Now, what if I don't want to sell my Bitcoin to come up with the cash, that 200,000? Is DeFi going to enable me to take my 500,000 of Bitcoin and put it into, some DeFi company as collateral, and then they're going to give me I can then get 200,000 of US dollars cash out. Then I can take that 200,000 and I can pay Wells Fargo because they're originating my loan. So there's my 200,000. And so I don't have to come up with any quote cash because I'm just putting my Bitcoin as collateral. I don't have to sell my Bitcoin and incur the capital gain on that. So is that an example of how this might either works today or how it might work in the future, or am I missing something here?
Totally. So again, the fun thing about software is that it's additive. So the things that are difficult and are recreated in multiple across a UBS and a Credit Suisse and an LPL and you name it, or the private banking services of I want to borrow against a painting. These are from a mathematical perspective of like, what is the function? What does it do? It's a trivial thing. You write it once and then you open source it, and then thank God nobody ever makes software about that again, because it's not a valuable human activity to keep reinventing that wheel, and if you put a house in a box or a piece of art or a crypto cat, it's sort of the same outcome. And so to your example in particular, there are two paths. If you are holding a bunch of Bitcoin, path number one, and again, you're likely wanting to interact with a regulated financial system, and so in that case, you'd be interacting with what the crypto industry calls centralized exchanges, which is basically just a normal company like a Coinbase
But
or.
they're bad, right? Centralization is bad.
Yeah, it all depends on your flag, right?
That's right. Yeah, that's right.
So you would. So what's the issue with centralization? The issue with centralization is that if India outlaws Bitcoin tomorrow, they can turn off all of the on-ramps and the exchanges, and all of a sudden what you hold is illiquid. So certainly, even an RIA that is very conservative in their investment outlook will appreciate that, thinking, if my custodian turns off access to my assets, my client's assets, I don't like that. And I don't like to rely on one custodian, and I might have both Schwab and Pershing. So RIAs are similarly decentralized in wanting to be multi-custodial. It's just a different word. So you might go with your position to an exchange like a Coinbase, and very likely you'll go maybe to Gemini, which is the Winklevoss twins of Facebook infamy, or other over-the-counter exchanges where you might have a bespoke transaction across a capital markets desk, the way that if you have 50 million worth of Apple stock and you want to take a margin loan against it, you go to your high net worth margin desk or capital markets desk in an investment bank or private bank. In the decentralized world, where the concept becomes orthogonal, it becomes quite just the foundational blocks are different. If you don't want to work with just the regular counterparty of a company, you can do all of what you describe, essentially, never talking to a human being ever. So you have the Bitcoin blockchain on which the Bitcoin lives, the Bitcoin asset lives. Now, Bitcoin is great, but it doesn't compute. It doesn't do anything other than move Bitcoin around. Ethereum is a computer, and it literally runs it. I'm out of my depth here to say it runs a Turing machine, but it runs a virtual machine, which is a simulated computer. And so what you can do is what's called an atomic swap between Bitcoin and Ethereum. So you do something on the Bitcoin chain, and then you do something on the Ethereum chain, and you transfer that value. You tokenize your Bitcoin so that it basically is locked and disappears from the Bitcoin blockchain, and it appears in a token form. In the terms of the industry, it's called wrapped. It's tokenized synthetic structured note. Same concept. So you get wrapped Bitcoin on the Ethereum chain as a token, and so again, a token would be a structured note type concept. And the nice thing about that, now that you're on Ethereum, again, is your multi-asset class. So you might take your wrapped Bitcoin, and then you might commit it as collateral into any number of protocols that would unlock a loan against it. So if you go to MakerDAO, for example, and now there are many others, you would be able to, again, put your token in a box, and then get in exchange a synthetic cash equivalent that is pegged to the US dollar. And there are a number of cash equivalents that are pegged to the US dollar, with money supplies in the single billions, give or take, 2 billion, I think 5 billion for the USDC one backed by Circle and Coinbase and so on. And so again, you've touched nothing so far. Now you've got 500K or whatever number we said in something like DAI, which is an algorithmic stablecoin. In other words, think of it as a money market fund or a cash equivalent or a cash sweep at Schwab, overnight repo, something like that. It's in a synthetic dollar stablecoin. And then you take that and you say, what do I want to do with this? Let's say I want to cash it out, and you don't want it to be in the form of DAI. You want it to be in the form of USDC, another stable coin, because that's what Coinbase likes. So you might use a decentralized exchange where you bring your capital to something like Curve or Uniswap, and you do a transaction against a robot, basically against a pool of assets. That pool might be 50 million or 100 million or 2 billion in the case of some of the protocols. And now you've swapped your cash into another form. And now you need an off ramp, right? So you can choose whether you off ramp the whole amount, or you can choose to put some combination of assets into a interest bearing account to actually simulate the mortgage that you described. You can take out the loan. So there's lots of these different machines that kind of enable you to do that. The hard thing is getting into cash, but as you are very well aware, the OCC last year crowned every American bank that has a federal license to be a crypto custodian. So literally, the thousands, maybe hundreds, maybe thousands of OCC chartered banks currently are allowed to custody crypto stablecoins. So I would say the distance between the world of the future and the world where we are today is really, really slim. I mean, we're literally there.
And so in this example, so it sounds like there's a way that I can get this $200,000 loan against my 500,000 Bitcoin as collateral, get the 200,000 out as US dollars to pay off Wells Fargo. So in that scenario, maybe this is not your area of expertise, but from a tax standpoint, would the government say, well, you've actually sold 200,000 of your Bitcoin and you owe tax on that? Or are they going to say, oh, this is just a loan against an asset, you didn't sell it, so there's no tax that's due because you're just putting up collateral?
I'm extremely not qualified to give you tax advice or any tax or financial advice. I believe, however, my intuition would be that if you're getting a loan collateralized by Bitcoin, you're not actually selling the Bitcoin asset, and therefore it is not a tax event. There is a bunch of hair around all this stuff in that. Yeah. If you, for example, like USDC is not the US dollar, so if you, there may be ways that you're going to get capital gains on your cash equivalent, because they're treated as a commodity, right? So for example, if I were to send you a car as a gift, you would have to pay taxes on that car, and you would not enjoy that because it's a car, but your taxes are in cash. So it's in the crypto ecosystem, there's a lot of stuff like this where people think of tokens as monetary objects, but in reality, you're kind of trading cars back and forth. And the IRS at this point of time has the stance that you should be keeping track of the cost basis and the market price of every collectible car. It's not a position that's practicable. It puts people in a place where they can't comply. It's impossible. So we'll see how that plays out. But I think in the transaction that you've described, where you are, if again you're putting a painting in a box and drawing a loan, that should not be a taxable event.
So let's talk about some fun stuff here. And one of the things that I'm particularly interested in as it relates to what's happening here with the cryptocurrencies and Bitcoin and what's called NFT, non-fungible tokens. So I'd like to talk about that, and because it's my belief, and tell me what your thoughts are, that there's a whole new range of potential investment opportunities, these digital goods, these non-fungible tokens that have scarcity. And I'm really interested in talking to folks like you who are really deep into this. Now, I know you personally are very interested in digital art. You're a digital art creator yourself. So I'd love to hear some of your thoughts around first of all, what is an NFT? So let's just start with that. What is the definition of a non-fungible token?
Sure. Um, I I will give you the definition. I want to give this example first before
Okay.
going into it, because I know the financial advisor mindset and the skepticism around anything that doesn't have the logic of DFA pie charts,
Or doesn't have
and
cash flow, and you can't
yeah,
do, discounted cash flow analysis. And
and there's certainly this element of like, is this getting people on a plan? Is this risk adjusted? Is this part of a package? And we're talking about these like one-off ideas, and it goes back to trading and products and, kind of yuck. And especially because so much of this is internet culture, so I would advise people to just be curious, to not necessarily say to run it through the grinder of thinking about, this is like an alternative of private equity, and just keep a curiosity as to how the world is evolving. And I was thinking about this the other day. I go into a supermarket and I buy a piece of bread, and the bread costs me $1.60. And then I think about the production process of that bread. How long ago were the seeds planted? How many people were in the tractors that processed the earth, right? How long did it take to grow? How was the bread baked and put together? What were the factories? How much transportation, how much electricity went into getting that bread into the supermarket? And here I am, purchasing this to fulfill a core survival need of the human body. Like, is this bread more important than the color of a video game character's hat? And the answer is yeah, the bread is more important, but it's also worth nothing. The bread is priced at zero. The $1.60 I'm paying for it, is marginal cost on a gigantic machine, which is basically an enormously expensive amount of labor historically has been reduced to essentially free. So feeding and doing these existential things for people that are super important and used to be the reason why everybody, populations died out, and was the existential crisis of the human existence was just survival, is $1.60. And my Spotify subscription's $10, and people on Ethereum are buying collectible digital characters for hundreds of thousands of dollars. Is the bread more important than a collectible picture on Ethereum? Yes, but it doesn't matter because it's already free. So over time, what's happening is that the products of the physical world, including things like the cash flows of a company that does real things in the real world, delivers that bread, cleans the streets, manufactures cars, whatever it is, they are creating economic space for new demand. As our basic demands are satisfied, there's new space for new demands, right? And so that brings us to the digital world and the world of non-fungible tokens. So what is it that, at the edge, what are people buying? They're buying digital objects that they can collect and prove that they own it, that there is scarcity around the object, they control it, that other people can't have it in a very tangible sense. In the same way that I can't take your Bitcoin unless you give it to me, I can't take an NFT from you. And so the NFT, the word fungible is like an economic word to mean, one and the same. So $1 is fungible with another dollar. One Bitcoin is fungible with another Bitcoin. Non-fungible means unique and different. So for example, if I have two different shirts, both say ConsenSys, but one is blue, the other one is red, they're non-fungible. They're different objects. And so non-fungible tokens are a standard of a digital asset on the blockchain, which are not part of some large divisible whole, but are collectible and distinct. So art is the first one to, it's very obvious. Collecting art, collecting digital decoration, collecting scarce manuscripts, collecting scarce cars, whatever it is, all of these are non-fungible. And so kind of after this first wave of financial infrastructure and rebuilding all this financial software, the next thing that seems to be happening is that the fruits of the economic world that is digitally native, the economic world that is not in our physical world, but that is in the virtual lands of video games, that is in the virtual lands of YouTube and Spotify and all these ecosystems we spent the last 20 years building out. Those digital objects are anchored and scarce and exchangeable. And so that's not a quick definition. I totally ruined the answer, but I think it's important to get that context of why what seems like a toy might hold hundreds of multiples of value versus something as existential as a loaf of bread.
So let's take the art for a second, and then I've got another example that I want to explore here, this idea of social tokens or social money as well. So let's take art. And again, for those of you that are watching the video here, you can see this background that Lex has, which is a Van Gogh. So let's say that that's actually, that someone created a digital piece of art and they only made, quote, 10 of them. So the blockchain makes it clear there's only 10 of these that'll ever be available. You've got the real thing if you've got one of these 10. Well, then what if the artist goes in, since this is all digital art, and they just change, a few squiggles in the background, and now it's a new piece of art, but just looking at the original 10 and now this new one, you really can't see that there's much difference, but technically there is, because they changed a few squiggles. Maybe I'm just being cynical, but, and maybe that's an extreme example, but how do we think about that when it comes to something like a digital art? Do they just tweak a little thing and oh, this is a new one, and then all of a sudden what you were paying hundreds of thousands of dollars for is now not worth a lot because there's very similar versions of it out there?
I think it's a really, it's actually a very straightforward and easy question. I think the even more amped up version of this question is like, well, why don't I just, what makes you own it? Why don't I right click and save it to my desktop? And there it is. I have this picture. And I think in that view, there is kind of a misappreciation for what ownership and it really is.
Mhm.
And this is also not a new problem, right? It's exactly the same problem of, yeah, you've got the Mona Lisa. I've got a high definition camera. I'm going to take a really nice picture of it, and then I'm going to print out a poster and put on my wall. Mine looks just as good as yours. Why is the Mona Lisa worth more than my poster? And the answer is also simple. All this stuff is invented in our minds. There's no such thing as art. There's no such thing as fundamental value. It's all a cultural, socially agreed upon convention about what we find fashionable and valuable. We being the human collective. There's no other thing. I mean, modern art is valuable because it signifies a historic moment. And that piece of Andy Warhol versus that poster of Andy Warhol is valuable because Andy Warhol painted that one and not the other one. And that's it. It's not about what it looks like or anything else. It's a cultural artifact, and we ascribe to it social value. And similarly, these are digital objects with social value. The copy that is scarce, digitally scarce, but not made by the artist is just that. It's digitally scarce, but not, it's a reproduction. And so I don't think it's a new problem. I think it's slightly novel because we're sort of used to digital objects being worthless, but I would say that was an unpleasant and incorrect moment in technology history for which we've paid with, the outcome of digital goods being worthless is Google and Facebook and the advertising economy. And I think that's taken us as far as we could go.
Yeah, well, that's very helpful to understand how you think about that. And I think that makes total sense. Let's talk about this idea of social money or social tokens. And So my understanding of that is, let's say that I'm a creator and maybe I'm early in my career or even late in my career, it doesn't matter. But I have a potential stream of earnings that I can make from creating my products. And it sounds like it's possible now where I can issue a token of some type. People will pay some amount of money for that token. That money comes to me as the creator. And then through the smart contract, it's pre-programmed in there that these people who own this token, they may get a certain percentage of my income as specified by the contract for some period of time, or maybe by owning the token, they get special access to things that I create, or they get special parties that they get invited to, or they get to go to my clubhouse group or whatever. Am I thinking about that correctly? What is all that?
Yeah. So this is the kind of the DJ mashup moment in um, the intersection of software and culture. I think sort of the cubists in the 1910s discovered collage, and the DJs towards the end of the century discovered samples, and here we are like that, but for software function. And I'm personally not cool enough to be representing what is actually going on here, because this is being done at the cutting edge by people who are really leading culture, that are um, musicians, for example, who are um, splitting up their tracks and giving ownership to the different parts of the tracks to their communities to reuse in certain ways. Or there's a project called Async Art, which is fantastic, where a piece might have 6 or 7 different layers, and you might try to buy a layer of a painting, which is owned collectively, communally owned. You might buy one layer and you can swap it out and change it, and so you have this ever growing and living art project, which is through ownership evolves and changes. And then of course you can bolt onto that different capabilities. So ConsenSys has a Discord channel where people come for community and to provide feedback and complain how MetaMask isn't working or whatever it is. And one of the cool things that our community team did recently was issue an NFT that, if you hold in your MetaMask wallet, opens up a Discord channel for insiders. And it's kind of cute, but you can see how once these things become more complicated and interesting, you're getting to a really crazy place, right? So Little Michaela is a synthetic influencer on Instagram with a couple of million followers, run by a team, and she's got NFTs that she sold that are participatory. Beeple is an artist that does digital art, has been doing sort of this like 3D rendered pop art for a decade for free, made 3.5 million from a sale recently. Rick and Morty creator sold a bunch of sketches for 1.7 million. And so you can start to imagine how holding these pieces might connect you into the creative process. It might give you rights to it might be a version of crowdfunding and give you rights to influence what is in a story, or what a synthetic character like Little Michaela would do. The choices that synthetic character would have. And then there are examples, and these are a little hokey, but they're examples of people, usually young people, who there's one guy who did a token offering of himself, and he's got a community that has bought his token, his social money, and is able to vote on his life decisions, however bracketed that is for this particular person. So I think we're going to see a lot more experimentation around not assets being a thing you put into a box to grow because you want to retire and die one day, but these are ways to participate in these are human experiences and ways to participate with your fellow people, and your participation is in fact what ends up making them valuable, the way that Facebook becomes valuable because you put things on it, or YouTube becomes valuable because you create content for it. In a similar way, these decentralized digital ecosystems are building machines that reward the community for actions they take and accrue value to the user. Now that sounds very utopian, and there are 1,000 ways that's going to go wrong. But as a starting point and as a direction of travel, I think it's far more compelling than sort of the Peter Thiel version of the world, where everyone is a Ayn Randian agent whose goal is to build a monopoly to kill everyone else
And moved to New Zealand.
and move to New Zealand or Puerto Rico or wherever it goes.
Yeah. Well, and so what I'm hoping to do with our conversation today, at least one of the things, is just let people know that there's some really fascinating things going on here. And while you're not going to allocate 5% of your client's assets to non-fungible tokens on digital art right now, it is interesting to kind of pay attention to what's happening, because there will be a point in time where there will be opportunities to invest in some of these things. I mean, there are today, but they're not necessarily mainstream. You mentioned utopia. So let me give you another example here and tell me if this is something that either is happening or could possibly happen. Let's say, well, we know we've got a big problem with student loan debt, and people, can't afford to go to college. So let's say I'm the University of Wisconsin, and I want to create some kind of social token. And so I'm an investor. I want to support people and help pay their way to college. So let's say I give money to the University of Wisconsin, and in return, I get some kind of token. University of Wisconsin takes all the money from the token, and then they use that to pay for tuition for people who can't otherwise afford to go to the University of Wisconsin. And then because of the smart contract, maybe it pools all of the deal is that they go through school and then they graduate. And then for the next 5 years, a certain percentage of that person's income gets paid out through the social contract or through the social token to the people who own the tokens. I mean, is that even possible? Is that something that could happen? Or is that just creating a more difficult way to accomplish something that we're doing in a different way today?
So there are two aspects to that, at least. Number one is, will there be an education model that is not as destructive to the finances of the average American? Should there be one? And the answer is yeah, there should be. I mean, what is happening now is, with broad strokes, you could call indentured servitude, right? In the sense that the cost of education is outpacing inflation by some crazy number, and you have completely undifferentiated undergrads coming out with 100K in debt and so on. So in a COVID digital world, will there be a more innovative approach to education that might, instead of a fixed rate, take a personal credit? I think the answer is, if not from the state, then certainly from the Silicon Valley or some other innovation hub. Somebody's going to do digital learning way better than your local college. No question about that. Is it going to scale? Who knows? Separate and apart from that, how would you do that today? And the answer is, well, DocuSign's a big company. You can do a lot of paper to create these things. And what you get out of the decentralized software world is that the entire life cycle of that financial instrument is essentially out of sight and out of mind. So if you are able to, for example, direct deposit into some version of on-ramp into MetaMask that ties it to your address, MetaMask being a crypto wallet, and then that is associated with your token, and your token is able to then send regularly scheduled payments to some other address, some counterparty. Again, from a software perspective, this is not a hard thing to do, and it would remove the actual functional friction of any sort of process that you need other than just engaging with a couple of clicks and a button and make it happen. So I think it is it is technically feasible. There's lots of social dynamics around it, of course, that uh, at this moment I think make it out of reach.
Right. All right. Well, I think we should probably be wrapping up here. And anything else here, Lex, that you want to add that we haven't talked about? Any exciting things that you're working on, or things we should be keeping our eye on here over the course of the next 12 months?
We've covered a lot of fun futurist stuff. Again, I would just ask people to be curious and understand that people are playing around and enjoying innovation, and it's available to everyone. There's no barrier to participate in this innovation. It is not foreign. It is not scary. It's just something that can be part of your life if you choose. If you want to learn more, ConsenSys.net's got a whole bunch of background on blockchain and Ethereum and a variety of products. I'll plug for the third time MetaMask, which is super easy. You can get it on your browser, you can get it on your phone. Put in $500 and you're off to the races. You're in the new world and can interact with anything you like. And then for those that are interested in more of my writing, check out fintechblueprint.com.
Excellent. Yeah. And I would second that on the FinTech Blueprint. It's a great newsletter and um, great writer. So just love the stuff that you're putting out there. And so things that we're talking about here today, you cover a lot of these different topics in that newsletter. And it's just a great way to stay on top of what's happening here. And I also want to reiterate what you've said here a couple of times about just this idea of being curious. So even if you're not going to be investing in all this stuff right now, which is totally fine, just start paying attention to this stuff, because I think the more that you take an interest in this, you're going to be ahead of the curve. You're going to see what's going on. You're going to be early to the game. But and there could be some financial rewards to that. But even beyond the financial rewards, it's just the psychic benefits of trying to understand this stuff and know where things are going and how that's going to impact you as an individual. And if you're a financial professional, how this might affect your clients down the road, I think is invaluable as well. So Lex, as always, it's great to chat with you, and appreciate all the great work that you do.
Anytime. Happy to be here.